Welcome to the Deep Dive, where we unpack the insights you've asked for. Today we're taking a magnifying glass to something that touches every single one of us, whether we realize it or not. The subtle yet profound rhythm of cycles. Have you ever caught yourself trying to predict what's coming next, whether it's, the financial markets, a career move, or even just the latest societal trend? There's this almost primal human desire to foresee the future. But in complex systems, especially those shaped by human decisions and emotions, is it truly possible to know what's around the corner? Or are we mostly just, guessing?
It's a crucial question. And what's particularly insightful is that even some of the most successful investors share that skepticism about precise predictions. Howard Marks, whose work is our focus today, holds a core philosophy that we cannot know the macro future, the big picture of economies, markets, geopolitics, with precision, or consistently better than anyone else. Yet, he also observes that truly great investors often possess an exceptional sense for cycles. They don't predict the exact destination, maybe, but they instinctively understand the nature of the journey, the ups and downs.
And when we talk about Howard Marks, we're talking about an investor whose insights carry immense weight. Warren Buffett, maybe the most respected figure in investing, once said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something."
Wow.
That's quite an endorsement, isn't it? It immediately tells you the wisdom we're about to explore is incredibly valuable and definitely worth your attention.
It absolutely sets the stage for why this deep dive into his thinking is so critical for anyone looking to navigate complexity. It's not just theory, it's proven insight.
So let's get into it. Our mission today is to distill the wisdom from Howard Marks's really seminal book, Mastering the Market Cycle, Getting the Odds on Your Side. We're going to extract the most important nuggets of knowledge, maybe some surprising facts, and definitely the practical insights. We want to look at how cycles actually work, why they matter so profoundly, and most importantly, how you can use this understanding to your advantage in, pretty much any complex situation. Our aim is to give you those impactful aha moments and a clear shortcut to being well-informed without feeling buried under, a pile of information.
And to help us visualize this inherently complex concept, Marx offers a remarkably intuitive analogy. It's quite helpful, actually.
Yeah.
Imagine a pendulum, suspended over a midpoint, swinging back and forth. Classic image. Now, picture that pendulum turned on its side horizontally. And as it oscillates back and forth, you drag the whole thing from left to right across a page.
Okay, I think I see.
What you see traced out is the visual representation of a cycle. It's this continuous, undulating movement around a central point, or maybe a long-term underlying trend. It's not a straight line, ever. It's a constant dynamic ebb and flow that rarely, if ever, rests at that midpoint.
I see. So it's not just random motion. It's a driven oscillation, right? It suggests there's a central tendency things eventually return to, even if they constantly overshoot it in both directions.
Yeah.
That visual helps immensely. It's not just noise.
Exactly. There's a pattern, even if it feels chaotic sometimes. Why study cycles? The unpredictable? Predictable?
So given this backdrop, why should we dedicate our time to studying cycles? Marx describes them as the unpredictable predictable. That sounds like a fascinating paradox. Could you unpick that for us? Why is something so fundamental also so hard to pin down?
It's because, as Marx argues, cycles are an inherent feature of human-influenced systems. Think economies, think markets. Unlike purely mechanical processes that might run in a straight, predictable line, these systems are fundamentally affected by people. And human behavior, as Marx notes, is far from steady. Our collective actions, our emotions, they fluctuate from time to time, which makes cycles simply inevitable. They aren't random glitches in the system. They are built into the very fabric of how we interact with markets and, with each other.
And this next insight from Marx is particularly profound. The idea that cycles are actually self-correcting. He states, trends create the reasons for their own reversal. That's almost poetic.
It really is.
It implies that success, paradoxically, carries the seeds of its own failure. And conversely, failure can plant the seeds of success. So a booming market inadvertently lays the groundwork for a correction, and a downturn often sets the stage for recovery. Is that the idea?
Precisely. This core idea is beautifully captured by that classic adage, which Marx also cites. History doesn't repeat itself, but it does rhyme. While the specifics, the precise timing, the duration, the speed, or even the exact initiating reasons might vary from one cycle to the next, the underlying dynamics and the patterns of ups and downs remain remarkably similar. We see the same themes, the same human reactions, just playing out in different contexts, maybe with different players or technologies.
So it's less about memorizing dates and events and more about understanding the mechanisms that drive these patterns,
Yeah,
the underlying human stuff.
exactly. And these oscillations, like we visualized with that sideways pendulum, they occur around a midpoint or a secular trend. Think of a long-term economic growth rate, for instance. That's the line it's oscillating around. The extremes, those periods of irrational exuberance or deep despair, are what Marx terms aberrations or excesses. They always tend to regress toward that mean eventually. And because of the powerful momentum that builds up, they often overshoot the midpoint to the opposite extreme, which just keeps the whole swing going.
Okay, I understand the why behind studying cycles now. But what's the practical power of this understanding? How does knowing this translate into a tangible advantage for, us?
It can be truly transformative. Marx emphasizes that while absolute certainty about the future is unattainable, forget crystal balls having a knowledge advantage regarding the tendencies of these cycles is more than enough to achieve long-term success. You don't need to predict the next big thing perfectly.
So it's not about knowing what the very next ball drawn from the jar will be, but understanding what the contents of the jar are, correct? Like the overall probabilities.
That's a perfect way to put it. Marx uses that very image. Imagine a jar with 100 balls. If you know that 70 of them are black and 30 are white, you can tilt the odds in your favor by betting on black. You still can't predict the next single draw, but over many attempts, you'll win more often. Superior investors, he argues, possess a deeper understanding of these future tendencies. They grasp the underlying odds within the market's jar, and that allows them to play a smarter game over the long run.
That's a powerful shift in perspective. Instead of chasing fleeting predictions, you're essentially building a probabilistic edge. How does Marx suggest we leverage this?
This knowledge allows you to convert cycles from what feels like a wild, uncontrollable force that wreaks havoc into a phenomenon that can be understood and taken advantage of. He calls it a vein that can be mined for significant outperformance. By recognizing where you likely are in a cycle, you can strategically reposition your probability distribution, biasing future events in your favor. This awareness, he contends, is a significant contributor to the edge needed for superior investment results. It's about creating your own luck through informed, disciplined action rather than simply hoping for it.
Okay, that makes sense. It's about playing the odds better because you understand the game board. 2-3. The anatomy of a cycle. More than just ups and downs. We've talked about why cycles exist. Now let's maybe pull back the curtain a bit and truly dissect them. Marx shows us they're far more intricate than just simple ups and downs, starting with cycles in economic output or GDP.
Indeed. While long-term economic growth, which is fundamentally driven by factors like birth rates and productivity gains, tends to be relatively steady over many decades. Consider, for example, how China's one-child policy required, 2 decades to genuinely affect worker numbers. Short-term GDP growth consistently oscillates around this established long-term trend line. So the underlying secular trend can be quite stable, maybe moving slowly upwards over time, but the year-to-year variability in economic activity is actually quite significant. Big swings.
And it sounds like economics itself, as a discipline, sort of contributes to the difficulty in getting a clear picture of what's happening in the short term, the dismal science aspect.
That's a keen observation. Marx highlights that the workings of economics are often unclear and imprecise, which is precisely why it's often referred to as the dismal science. This inherent imprecision makes direct, reliable short-term predictions extremely difficult, maybe even impossible to make consistently better than others. There's just too much complexity.
So if the fluctuations aren't purely driven by mechanical economic factors, what is the primary driver of these short-term economic cycles? What's really pushing things around year to year?
It's heavily influenced by psychology, emotion, and decision-making processes. Human stuff, basically. Think about it. Changes in consumer marginal propensity to consume, that's simply how much of an extra dollar people decide to spend versus save, can be swayed by everything from daily headlines to election results or even just the availability of credit. The wealth effect, where people feel richer and spend more because their assets like stocks or homes have appreciated, that plays a role too. Even something as seemingly trivial as your favorite sports team winning a major championship can temporarily boost consumer sentiment.
Really? The sports team?
Studies have shown small effects, yeah. And businesses, too. They adjust inventories based on over- or underestimating demand, leading to production cuts or increases. These are all human-driven fluctuations that contribute to the cycle.
And that leads directly to Marx's well-known skepticism about macro forecasting for outperformance, doesn't it? If it's also influenced by fickle human behavior, how can anyone consistently predict it better than, the average person?
That's his key message. He argues that trying to predict the macro future, the broad movements of economies, markets, or geopolitics, is unlikely to lead to superior investment performance, because very few people, if any, can consistently know more than others about those things. As he states, it's only if we know more than others that our forecasts will lead to outperformance. If everyone possesses the same information, analyzes it in the same way, and arrives at the same conclusions, then you're simply going to achieve average results at best. The market already reflects that consensus.
It's logical. To outperform, you need to be unconventional in a way that turns out to be correct. And that's hard.
Precisely. Valuable forecasts, in Marx's view, are those that correctly foresee deviation from long-term trends and recent levels, and by their very nature, these are unconventional. But the significant catch is that most unconventional forecasts, well, they turn out to be wrong. That makes them unreliable for consistent outperformance. He famously quotes Milton Friedman, who observed that forecasters often see the same data, read the same material, and spend their time trying to guess what each other is going to say. Friedman concluded, their forecasts will always be moderately right and almost never of much use.
Moderately right, but not useful for beating the market. Okay, so the actionable takeaway here for listeners seems pretty clear. If your goal is to outperform, don't rely heavily on consensus economic forecasts. They're likely already priced in.
Absolutely. The true wisdom lies not in trying to predict the herd's next move, but in understanding how the herd behaves and how that behavior impacts market dynamics. It's about understanding the process, not the specific outcome.
Okay, so GDP fluctuates, influenced by human factors. But what about corporate profits? Marx says they're even more volatile than the overall economy. How can that be? Isn't it all linked?
It's what he terms an amplification effect. While the collective sales of all businesses do generally track GDP, corporate profits swing much more dramatically than GDP. This is due to a few powerful factors working together.
Can you walk us through those? Sales responsiveness, for instance, what does that mean?
Yes, that's one. Demand varies significantly by industry based on the economic cycle. Industrial materials, for instance, are highly responsive. When the economy expands, businesses need more chemicals, metals, energy, that sort of thing. Necessities like food or medicine are less responsive. People still need them, though even there, people might trade down to cheaper alternatives in a recession. But durable goods, big-ticket items like cars or factory equipment, are highly responsive because their purchase can often be deferred when economic conditions are uncertain or people are worried.
That makes perfect sense.
Yeah.
If you're worried about your job, that new car can wait, or that big factory upgrade.
Exactly. Beyond just sales, there's also operating leverage. Most businesses have a mix of fixed costs, like rent, semi-fixed costs, maybe some core staff, and variable costs, like raw materials. Marx uses the compelling example of a taxi company. Their office space is a fixed cost. It remains the same whether ridership goes up or down a little. Their fleet of taxis is semi-fixed. They can handle some increase, but eventually they might need more cabs. Gasoline, however, is a variable cost. If cabs drive 20% more miles, gas consumption rises by 20%. So here's the key. If the company's revenue increases by, say, 20%, its total costs increase by less than 20% because of those substantial fixed and semi-fixed costs. This means the increase in operating profits will be considerably greater than the 20% increase in sales. That's operating leverage at work.
Ah, okay. So a relatively small change in revenue gets magnified on the way down to the profit line.
Magnified, exactly. And it's magnified on the downside, too. A small drop in revenue can cause a much bigger percentage drop in operating profit.
So that's a powerful multiplier already.
It really is. And then there's financial leverage, which amplifies it even further. Companies often finance themselves with a combination of equity, owner's money, and debt, borrowed money. The crucial aspect of debt is that it carries fixed interest payments, regardless of how well the company is doing profit-wise. Marx illustrates this. Imagine a company financed half with debt, half with equity. If its operating profits decline by, say, 33%, that drop might have to cover the same fixed interest payment. What's left for the shareholders, the net income could plummet by 67% or even more. The fixed nature of interest payments means that even a modest dip in a company's operating profits can lead to an outrageously large percentage drop in net income.
Wow, that's a stark illustration of how vulnerable companies can be to even small economic shifts if they're highly leveraged with debt.
Precisely. And finally, you have idiosyncratic factors. These are things unique to a specific company or industry, often independent of the broad economic cycle. Think about how technology can completely disrupt an entire industry, like streaming services disrupting cable TV.
Or the impact of management decisions, good or bad. Changes in regulation, even external events like extreme weather, war, or just fleeting consumer fads.
Exactly. Marx cites the newspaper industry as a prime example. In the 1990s, newspapers were considered defensive businesses, incredibly stable revenues, almost impenetrable moats due to their essential role in local news and advertising. Rock solid, people thought.
But then the internet fundamentally changed everything. Didn't matter how defensive they seemed.
Exactly. In less than 2 decades, the internet completely disrupted their business model. Information became freely available online, advertising migrated to digital platforms like Google and Facebook. Suddenly, this defensive industry was struggling massively, regardless of general economic conditions. So the combination of sales responsiveness, operating leverage, financial leverage, and these idiosyncratic factors means that profits are far, far more volatile than the underlying economy. This creates significant swings for investors, both risk and opportunity.
So what does this all mean for someone navigating these markets? You can't just look at GDP forecasts. You have to understand these amplification effects on profits.
It means you need to dig deeper. It creates both greater risk for the unwary investor who doesn't understand this and greater opportunity for the discerning investor who does. 3. The power of psychology, the pendulum of investor emotion.
We've talked about economic cycles, profit cycles, and how imprecise they can be, especially with human behavior thrown into the mix. Now let's get into what Howard Marks calls the pendulum of investor psychology. He specifically prefers the term pendulum when discussing emotion, even though it sounds conceptually similar to cycles. What's the distinction he's making there? Why pendulum?
He does make that distinction. He says the mood swings of the securities markets resemble the movement of a pendulum. It is almost always swinging toward or away from the extremes of its arc. The key idea is that, like a physical pendulum, it spends very little time at the exact midpoint, or what he calls the happy medium. Instead, it's constantly driven toward one extreme or the other. And importantly, the very movement towards an extreme actually supplies the energy for the inevitable swing back in the other direction. It's less a predictable rotation like a clock, and more a dynamic emotional oscillation.
That's a powerful image. It feels more energetic, more forceful than just a gentle cycle. So what are these core emotional swings that drive this pendulum?
Marx identifies several key continuums, these back and forths. First, between euphoria and depression. Markets tend to either celebrate everything positive, sometimes ignoring negatives, or obsess over everything negative, ignoring any positives, rarely maintaining a balanced view for long. Second, and perhaps most obviously, greed and fear. This is the big one. In a healthy, rational market, these might be balanced in a sort of tug-of-war, but at the times that really count, Marx observes, large numbers of people leave one end of the rope for the other. Everyone rushes to one side.
Can you give an example of that rush?
Think of the tech bubble of 1999. Greed was overwhelmingly dominant. The prevailing mentality was buy before you miss out. Fear of missing out. FOMO was rampant. Then contrast that with 2002 after the crash. Fear took over completely. It became sell before it goes to zero, or a generalized distrust, like I'll never trust management again.
And skepticism versus credulousness too, right? Where investors swing from healthy, prudent doubt, which is good, to an unquestioning acceptance of sometimes dubious claims.
Yes, that's another critical swing. Healthy skepticism gives way to just believing anything, especially narratives that promise easy riches. And related to that is the willingness to value the future, whether it's perceived as full or empty. In good times, investors will pay handily for future potential, even if it's uncertain and way off in the distance. They see the future as full of promise. In bad times, they see that same potential as largely empty and are unwilling to assign much, if any, value to it.
He uses a building analogy for that, doesn't he?
Yes, the real estate analogy. What's an empty building worth? It has some replacement value, maybe, but no cash flow. A full building with paying tenants and steady cash flow is worth much more. Investor psychology, he says, dictates whether the building, the underlying asset or company, is perceived as full or empty, and that heavily impacts its perceived value and the price people are willing to pay.
So understanding these psychological swings sounds like an absolute entry-level requirement for any thoughtful investor. You have to grasp this first.
He calls it precisely that. An entry-level requirement for avoiding harm from cyclical extremes, and hopefully for profiting from them. You ignore investor psychology at your peril.
And a big part of that, I imagine, is understanding the cycle In attitudes toward risk, this
Yeah.
is where, in practice, a lot of people seem to get it fundamentally wrong, that risk-return chart.
They do. There's a common misinterpretation of the standard risk return graphic, the one where the line slopes up and to the right. People often read it as riskier assets produce higher returns, like it's a guarantee. Marx clarifies this very carefully. He says, investments that seem riskier have to appear to promise higher returns or else no one will make them. It's about the promise, the potential needed to attract capital. If they guaranteed higher returns, they wouldn't actually be riskier by definition. Risk for Marx is primarily about the likelihood of permanent capital loss and the uncertainty surrounding the range of outcomes, not just how much the price bounces around day to day, which is volatility.
That's a fundamental distinction. Right. So it's not a promise of higher returns, but a necessary appearance to attract capital, reflecting the average investor's aversion to risk. They need to be coaxed into taking risk.
Exactly. And a crucial insight from Marx, maybe one of the most important, is that attitudes toward risk change, and in so doing, they alter the investment environment. This shift in risk perception is one of the most powerful cycles he identifies. In good times, when optimism is high and things feel safe, investors become increasingly risk tolerant. They jettison their caution, they start accepting skimpy risk premiums, meaning they don't demand much extra return for taking on extra risk, and they lose interest in the safer end of the investment spectrum. Why buy boring bonds when stocks are soaring?
And this often leads to that race to the bottom, right? Especially in lending.
Exactly. A race to the bottom in lending standards often occurs. The prices of risky assets rise disproportionately relative to safer ones because everyone wants the potential high return, and nobody seems worried about the risk anymore.
And that's when things get truly dangerous, isn't it? Paradoxically, when the market feels safest, when risk perception is lowest.
Precisely. Marx famously states, risk is high when investors feel risk is low, because when no one is worried, no one demands protection, standards slip, prices get bid up, and the actual underlying risk quietly accumulates. It creates what can feel like a virtuous circle of irrationality. Positive market events, increased optimism, more risk-tolerant investors, lower risk premiums demanded, lower required returns on risky assets, prices rise further, which attracts more buyers, making assets even riskier because they're now more expensive.
A feedback loop pushing prices away from reality. And the inverse happens when times are bad, I assume.
Yes. When economic conditions are unfavorable or the market is in a downturn, investors become overwhelmingly fearful. They perceive markets primarily as places where money is lost, not made. They avoid risk at all cost. This collective fear, this aversion, causes asset prices to fall, sometimes drastically, often to levels where, ironically, losses are highly unlikely and gains could be enormous. The potential reward becomes huge precisely because everyone else is terrified. The practical application here is profound. The reward for bearing incremental risk is greatest at just the moment when, just because people absolutely refuse to bear it.
That's when the truly contrarian opportunities emerge, when you're willing to step in precisely because everyone else is running away. Can you give us a real-life example of this extreme risk aversion in action? Maybe that anecdote Marx tells about the pension fund during the GFC. It's quite vivid.
Oh, it's a fantastic story. It really illustrates the point. It's from the aftermath of the 2008-2009 global financial crisis. Marx recounts a personal experience with a major pension fund during that period. His firm, Oaktree, had formed its first levered funds that borrowed money to amplify their investments just before the crisis hit. Now, even though they were more conservative with leverage than many others, they still faced the possibility of a margin call as loan prices just plummeted during the crisis. So Marx was trying to raise additional equity from the fund's existing investors to reduce the leverage and protect their positions in these senior loans. He was essentially offering them a chance to invest more money to hold on to senior loans, relatively safe parts of the capital structure at yields to maturity that were well into double digits. The potential levered returns on the overall fund were projected in the 20% range. These were, on paper, incredibly attractive opportunities, especially given historical default rates on such loans.
So he's presenting an investment that, by all rational historical measures, looks incredibly promising given the distressed prices. A potential bargain created by the panic.
Exactly. But the pension fund's repeated question, despite all the compelling data Marx presented, was always, but what if it's worse than that? Just pure Fear talking. Marx would respond by escalating the historical worst-case scenarios for default rates. He'd point out that Oaktree's own average default rate over, 26 years in high-yield bonds, which are junior and riskier than the senior loans they held, was only about 1% a year, with actual credit losses even less after recoveries.
And the pension fund still wasn't convinced.
Nope, they'd still ask, but what if it's worse? So he'd then cite the worst 5-year period in history for high-yield bonds, averaging maybe 3% default per year. Or the average default rate for the entire high-yield universe across all time, around 4.2%. Still, the response was stubbornly, but what if it's worse than that?
Wow. Even after hearing the actual historical worst cases, they're still fixated on some undefined worse-than-worst downside. They just couldn't see the potential upside through the fear.
Indeed. He pushed the scenario to the absolute extreme. He mentioned the worst single-year default rate in high-yield bond history up to that point, which was 12.8% in one particularly bad year. And even then, the pension fund manager asked, but what if it's worse than that? Marx even hypothesized a scenario of 1.5 times the worst year in history, like a 19% default rate, something truly unprecedented, and still demonstrated they'd likely make a small profit given the high yields the portfolio was generating. But the fear was just too strong.
Seriously.
Yeah.
That's incredible. It just shows how paralyzing fear can be, completely overriding rational analysis. And what did Marx ultimately do in that situation? Did they just let the fund fail?
Well, a few of the fund's investors, including that specific pension fund, declined to put up the additional equity needed. Marx, feeling a strong obligation to do everything he could to keep the fund afloat and protect the remaining investors, stepped in and invested a significant amount of his own money in their place, taking up their share of the capital call. He describes it, with hindsight of course, as one of the best investments I've ever made, precisely because the widespread unwillingness of others to participate in that market, driven by that extreme fear, had pushed the value of those loans down to absurdly cheap levels.
That's a truly powerful lesson in contrarianism and conviction. The key takeaway from this, then, is that rational investors need to be skeptical and appropriately risk-averse, sure, but they also have to be constantly on the lookout for those outsized opportunities that only arise when others are being irrationally risk-averse.
That's it. Marx observes that most investors are most willing to buy when they should be most cautious and most reluctant to buy when they should be most aggressive. Superior investors, therefore, strive to do the opposite. They aim to be the buyers when everyone else is panic selling.
It's all about recognizing when the collective human emotion has pushed that pendulum way too far to one side, and then having the fortitude, the guts, really, to act against the crowd. Easier said than done, I imagine.
Definitely takes emotional discipline. Cycles in practice, money, markets, and real assets.
Let's transition now from the psychology to its practical application in various markets. Marx delves into several specific cycles, starting with perhaps the most volatile of them all, as he calls it, the credit cycle. He also calls it the spigot of capital. I like that image.
It's a very fitting description. Marx contends that the credit cycle is the most volatile of the cycles and has the greatest impact on economic activity. It's a mechanism that opens wide and then slams shut with extreme power, and its movements profoundly influence other areas of the economy and financial markets. It's fundamental.
Why is the availability of capital through this spigot, this credit market, so crucially important? Why does it have such a big impact?
There are two primary reasons. First, companies constantly need capital. They need it for growth-building factories, developing products, but also, crucially, just to refinance maturing debt. Most companies don't actually pay off their debts when they come due. They merely roll them over by issuing new debt to pay off the old debt. If a company can't issue new debt when its existing debt matures, perhaps because the credit market has tightened up, even fundamentally strong companies can be forced into default or even bankruptcy. It's not necessarily about their core business failing.
Just access to funding drying up.
Exactly. Second, financial institutions, banks, investment firms, insurance companies are especially reliant on credit markets because their entire business model revolves around trading money. They often borrow short-term, like deposits, to lend long-term, like mortgages or business loans. They require constant, stable access to capital to function day-to-day.
And this dependence on capital in times of easy money leads to what Marx calls the race to the bottom, when the spigot is wide open and flowing freely.
Exactly. In times of prosperity and low-risk aversion, when everyone feels good, capital providers, the lenders and investment funds are eager to expand their book of business. They want to lend more, invest more. Money effectively becomes a commodity, and the competition to deploy it intensifies. This drives a race to the bottom where lenders, desperate to put money to work and earn fees, start accepting lower yields, less return, and increasingly riskier structures. They might demand fewer protective covenants in loan agreements, do less rigorous due diligence on borrowers. This results in what Marx describes as cheap financing, low credit standards, weak deals, and the unwise extension of credit. He vividly characterizes this process as stacking the logs in the fireplace for future problems. You're building up the potential for a big fire later.
So the very conditions of prosperity and easy credit are inadvertently laying the groundwork for future trouble. And then at some point, that spigot slams shut. Is that the next phase?
Yes, that's the painful part. When an igniter arrives, be it a recession, a sudden credit crunch triggered by some event, or an unforeseen exogenous shock like a geopolitical crisis or a major corporate failure, the unwisely issued bonds and loans from the boom period begin to fail. Defaults rise. Suddenly, buyers for new debt disappear. No one wants to lend. Prices of existing debt cascade downward as people try to sell, and the capital market effectively slams shut. This sudden unavailability of credit then intensifies and reinforces the economic contraction, turning what might have been a manageable downturn into a full-blown crisis.
So if the slamming shut is the painful part, what's a practical application of this knowledge for investors? How do you benefit from knowing this dynamic?
Well, the pain creates the opportunity. Marx argues that the slammed shut phase of the credit cycle probably does more to make bargains available than any other single factor. When capital is scarce and fear is pervasive, assets, especially debt instruments, can become incredibly cheap relative to their underlying value or recovery potential. Conversely, when the credit window is wide open, when loans are easy to get and everyone is lending freely, that's a signal to proceed with extreme caution. It tells you risks are likely building up. This understanding fundamentally helps investors time their aggressiveness and defensiveness. Be greedy when others are fearful, be fearful when others are greedy, especially in the credit markets.
Building on that, Marx also discusses the distressed debt cycle, which sounds like it's where you genuinely try to profit from other people's or companies' failures when that unwisely extended credit goes bad.
That's precisely it. Distressed debt investing involves buying the securities, usually bonds or loans, of companies that are either already defaulting on their debt or are highly likely to do so in the near future. The motivation here isn't typically to receive the promised interest and principal payments as usual, because those are often expected to fail or be significantly restructured. Instead, the goal is to acquire claims, essentially a piece of the company's debt at a very low price, often pennies on the dollar. These claims might then convert into ownership equity of the company after bankruptcy, or into new restructured debt, potentially offering significant upside if the company recovers or its assets are sold.
And what are the essential ingredients for creating these opportunities in the distressed debt space? What needs to happen?
Marx says there are two critical ingredients that must come together. First, you need the unwise extension of credit, which is the fuel we just discussed. Those weak bonds and loans issued with little margin of safety during the hot, easy credit markets of the boom times. That's the raw material. Second, you need an igniter. This is the spark that causes widespread defaults among those weak credits. Typically, it's a recession, a severe credit crunch where refinancing becomes impossible, or a significant exogenous event. Marx cites specific historical igniters like the 1990 Gulf War, the wave of bankruptcies following the highly leveraged buyouts of the late 80s, and even the legal troubles of figures like Michael Milken as events that triggered major distressed debt cycles.
And then it's a vicious circle that leads to bargains, but ultimately it turns into opportunity for those prepared.
Yes, exactly. Increased defaults trigger fear, leading to capital fleeing the market. Buyers become scarce, and sellers proliferate, often because they have to sell, like mutual funds facing redemptions. This creates intense selling pressure. Prices cascade downward. Some funds face forced selling due to investor withdrawals or margin calls, and eventually bonds become available at any price, regardless of long-term value. These are the precise, difficult, often scary conditions that give rise to the ability to make bargain purchases of distressed debt. This can lead to opportunities for significantly elevated returns for those brave enough and capitalized enough to step in when things look bleakest.
But it's not all doom and gloom. There's a recovery phase too, right? The cycle turns back up eventually.
Absolutely. After the bottom is reached and the worst fears maybe don't fully materialize, the virtuous circle of recovery begins. The economy starts to stabilize or improve. The credit market gradually unfreezes and reopens. Default rates begin to recede from their peak levels. This combination causes the forced selling to abate, downward pressure eases, and prices of distressed securities begin to rise from their lows. Capital is attracted back to the market as returns start looking good again. The significant gains on bonds purchased near the bottom are noticed, encouraging further investment and pushing prices higher. Marx's crucial point is that each event in this cycle often causes the next. Boom leads to bust, leads to opportunity, leads to recovery, leads back to boom. Opportunities arise most profoundly when others are fearful and fleeing, enabling the prepared contrarian investor to step in and potentially be amply rewarded.
Shifting gears slightly, but still within real assets, Marx also extensively discusses the real estate cycle. What makes it particularly unique compared to, say, the credit cycle we just talked about?
Well, it shares many commonalities with other cycles. You see the same patterns. Positive events fuel optimism, which leads to increased activity, buying, building, which pushes prices higher, which encourages more risk-taking, bigger projects, more leverage, eventually leading to oversupply or unaffordability, followed by a correction. Classic cycle stuff. But the unique element in real estate, especially commercial real estate, is the exceptionally long lead times required for development. A major construction project, like an office tower or a shopping mall, from initial planning and approvals to completion and opening, can take several years.
Ah, okay. So a large-scale project conceived in a booming market, when optimism is high, might only finish and come to market years later, potentially during a bust.
Precisely. Projects started when times are good, fueled by high optimism and easy credit, often open their doors in bad times, adding significantly to vacancies just when demand is falling. This influx of new supply puts severe downward pressure on rents and sale prices, which can exacerbate and prolong a downturn. Marx offers a compelling illustrative anecdote from his own firm's experience. His team profitably bought stalled or troubled projects during bad times. They acquired them from repossessing lenders, often at prices well below the original invested cost. They could then complete the projects more cheaply, maybe because labor and material prices had fallen. Then they brought the finished properties to market when conditions had eventually improved.
That's a perfect example of what he calls using the cycle to your advantage. Understanding those long lead times gives you an edge. But there's also a pervasive myth in real estate, isn't there? That persistent idea that home prices always go up. People really seem to believe that.
Yes, this was a widespread and deeply ingrained belief, particularly fueled by optimistic media coverage and even some academic researchers leading up to the 2007 global financial crisis. Many confidently proclaimed that homes were a guaranteed appreciation asset, an infallible investment. Just buy and hold, you can't lose.
But Marx cites some surprising counter-evidence that really challenges this widely held belief. Something about a very old house.
He does, and it's quite striking. He refers to a study of a single, virtually unaltered house located on a prime canal in Amsterdam, built way back in 1625. Researchers tracked its value over 350 years, and the result?
Was it?
Over 3.5 centuries, the real inflation-adjusted value of that prime location house increased by only 0.2% per year, basically barely keeping pace with inflation over the very long run. This dramatically challenged the myth of continuous, robust appreciation in real estate. It demonstrated that real estate is indeed cyclical and certainly not immune to long periods of stagnation or even decline in real terms.
That's a truly surprising fact. 0.2% a year over 350 years. That completely flies in the face of what most people assume. So cycles apply to real estate just as much as they do to other markets. No exceptions.
Absolutely. And this very illusion that prices could only go up played a huge role in the catastrophic 2007-08 housing bust in the U.S. and elsewhere. Rapidly increasing demand was fueled by declining interest rates, yes, but also greatly increased mortgage availability. This included financial innovations like low introductory teaser rates, 100% financing, no down payment needed, no documentation or liar loans, and the widespread rise of subprime mortgages designed for borrowers who couldn't meet traditional lending standards. Credit became incredibly easy to get for housing.
And the ratings agencies, the ones meant to be independent arbiters of risk, also played a significant, perhaps contributing role here, didn't they? They gave high ratings to bundles of these risky mortgages.
Unfortunately, yes. There was a troubling race to the bottom in rating standards for mortgage-backed securities, MBS. Credit rating agencies, competing fiercely for the lucrative business of rating these complex products issued by financial institutions, contributed to the bubble by often assigning overly optimistic, inflated ratings, like AAA, to securities backed by pools of risky mortgages. This was compounded by deeply flawed assumptions embedded in the complex financial engineering models used to create these securities. They often relied on the dangerously flawed idea that mortgage default across different regions would remain uncorrelated and benign, meaning defaults in Arizona wouldn't be related to defaults in Florida, and overall default rates would stay low. Of course, when the national housing market turned down, defaults became highly correlated everywhere.
And when the bubble burst.
When the housing bubble inevitably burst, those highly rated MBS became, as Warren Buffett famously called them, weapons of financial mass destruction. They led to massive defaults, collapsing housing prices, huge losses for investors and institutions holding them, and a complete drying up of credit throughout the financial system, which then cascaded into the broader global financial crisis.
So, once again, we see human behavior. The belief in this time is different. The suspension of analytical disbelief, the race for profits creating a massive problem that, in hindsight, had many warning signs, yet was incredibly difficult for many to act on rationally at the peak of the euphoria.
Precisely. The cycle played out with devastating clarity, fueled by psychology and flawed assumptions. V mastering the cycle, strategies for the thoughtful investor.
So we've dissected various cycles and seen their anatomy, how they play out in credit, real estate, profits. Now, how does a thoughtful investor actually master them, or at least navigate them better? Marx lays out strategies, starting with the general market cycle itself, which he breaks into 3 distinct stages for both bull and bear markets.
That's right. It's a useful framework. For bull markets, he describes 3 stages. 1, the first stage. This is when only a few unusually perceptive people actually believe things will get better. Prices are still at bargain levels. Optimism is very low, maybe even negative. These are the truly insightful early adopters, acting before the trend is obvious. 2, the second stage. This is when most investors begin to realize that genuine improvement is taking place. The evidence is becoming clearer. Prices are steadily rising and optimism is growing. This is when the trend becomes evident to a wider audience and more people start buying in. 3, the third stage. This is the most dangerous one. It's when pretty much everyone concludes things will get better forever. This stage is marked by excessive enthusiasm, a complete suspension of disbelief, maybe talk of a new paradigm, and prices get pushed so high that it feels like no price is too high. Caution is thrown to the wind.
But I'm guessing the bear market is just the mirror image of that playing out in reverse.
Precisely. It's the inversion. 1, the first stage of a bear market. This is when just a few thoughtful, maybe skeptical investors recognize underlying problems despite the prevailing bullishness and complacency still lingering in the market. They see cracks forming while everyone else is still optimistic. 2, the second stage. This is when most investors finally realize that conditions are truly getting bad. The negative news is undeniable. This leads to broad-based selling as realization dawns. 3, the third stage. This is the capitulation phase. It's when everyone concludes things will only get worse forever. This leads to widespread panic, indiscriminate selling the good with the bad, and asset prices falling far below any reasonable estimate of their intrinsic value. Maximum pessimism reigns.
This sounds very much like that classic Warren Buffett quote, first the innovator, then the imitator, then the idiot. Seems to map perfectly onto those stages.
Indeed, Marx uses that exact quote along with his own distillation, which is quite memorable. What the wise man does in the beginning, the fool does in the end. The early discoverer, the innovator, who acts without needing the crowd's validation, captures the bargain prices in stage 1. The late buyer, the fool or the idiot, pays way too much for overrated potential in stage 3, often driven by FOMO, the fear of missing out, just as the cycle is about to turn.
And Marx even gives us a humbling historical anecdote about someone you absolutely wouldn't expect to fall for this, Sir Isaac Newton. Despite his genius, he apparently fell prey to this fool-in-the-end mentality during the South Sea bubble.
Yes, it's a classic story. Sir Isaac Newton, the scientific giant, was actually the master of the mint in England during the infamous 1720 South Sea bubble. He famously lamented, "I can calculate the motions of the heavenly bodies, but not the madness of the people." Apparently, he wisely sold his shares in the South Sea Company relatively early, recognizing the speculative nature of the boom and making a decent profit. But then, as the stock continued its absolutely meteoric, irrational rise, fueled by public mania, he reportedly couldn't stand the psychological pressure of seeing his friends and others get even richer.
Oh no.
He eventually gave in to the FOMO, bought back into the market near the absolute top, and ended up losing a substantial sum when the bubble inevitably burst. It's a powerful reminder that emotional fortitude and discipline are absolutely crucial in investing, perhaps even more so than raw intellect. Even geniuses can get swept away by crowd psychology.
Wow, if Newton can fall for it.
Oh boy.
Okay, so how do we distinguish a true bubble from just a strong, healthy market rise? Mark seems very specific about his definition of a bubble. It's not just prices going up a lot.
That's right. For Marx, a bubble isn't merely a big market rise. It carries special psychological connotations. It's primarily marked by that pervasive conviction we mentioned. There's no such thing as a price too high. It represents a complete suspension of analytical disbelief, where traditional valuation metrics are utterly ignored or rationalized away. He offers two classic historical examples to illustrate.
The Nifty 50 in the U.S. market, back in the 1960s and early 70s, as they were called.
Exactly. These were considered the absolute top, fastest-growing one-decision stocks of their era, blue-chip giants like Xerox, IBM, Polaroid, Kodak. They were seen as companies you could buy at any price and just hold forever because their growth was assumed to be unstoppable. They traded at absurdly high valuations, sometimes 80 to 90 times earnings, based on this almost religious belief that it absolutely didn't matter what price you paid. The conviction was that their rapidly rising earnings would quickly grow into any price, no matter how high. Of course, that didn't happen for many of them, and many of these stocks later lost 80–90% of their value during the bear market of the 70s when that irrational ardor finally cooled.
And then, perhaps more recently and vivid for many of us, the internet bubble of the late 1990s.
That's another prime example, maybe even more extreme in some ways. Tech and dot-com stocks, many with absolutely no earnings, or sometimes even no significant revenues, traded at outlandish price-to-sales ratios or based on metrics like eyeballs. Red Hat, the software company, famously sold at 1,000 times its annualized revenues at one point during the peak. Yahoo, at its peak, was briefly valued higher than legacy giants General Motors and Ford combined. The price doesn't matter mentality was completely pervasive, coupled with what Marx calls a lottery ticket mentality. People weren't buying based on fundamentals, but on the slim hope of a 1,000% gain based purely on a concept or a story, not actual earnings. Many investors in these pure concept stocks ultimately lost 100% of their investment when the bubble burst starting in 2000.
The hallmarks of a bubble sound quite clear when you lay them out like that. No price too high, ignoring all analytical caution, widespread belief in a new era, and even people borrowing heavily to join the mania.
Precisely. And a willingness to extrapolate current trends indefinitely into the future. Marx famously advises, maybe a bit tongue-in-cheek, all you have to be able to do is identify nutty behavior when you see it. It's about maintaining detached observation, recognizing the signs of irrational exuberance, rather than getting swept up in the collective hype and speculation yourself.
Okay, so once we can identify these cycles and potentially spot this irrational exuberance, how do we effectively cope with them? What's the practical strategy Marx advocates? He talks about cycle positioning. What does that involve?
This is really where the theoretical meets the practical application. Marx's guiding principle, his North Star, as he sometimes calls it, is clear: to know where the pendulum of psychology and the cycle in valuation stand in their swings. He adds a crucial line: we may never know where we're going, but we'd better have a good idea where we are. Hint. This means a constant, disciplined assessment of the current investment environment. Not trying to predict the future, but understanding the present context deeply.
And how exactly do we do that? What are the key indicators he suggests we pay attention to figure out where we are?
He outlines both quantitative and qualitative indicators. Quantitatively, you need to examine core valuation metrics. Are price-to-earnings ratios on stocks high or low compared to history? Are bond yields skinny or generous? Are capitalization rates on real estate, which is simply the income a property generates relative to its price, compressed, meaning prices are high relative to income? Or are they at levels suggesting bargain valuations? High valuations usually imply low prospective returns going forward, whereas low valuations often signal potentially attractive future returns.
So check the price tag relative to history and fundamentals. And qualitatively, how do we read the broader market sentiment, the mood?
Qualitatively, you need to observe investor behavior and the general market tone. Are investors overwhelmingly optimistic, telling bullish stories, or are they deeply pessimistic and fearful? Is the media piling into a particular investment theme, splashing it on magazine covers, or are they shying away and focusing on gloom? Are novel, untested investment schemes being readily accepted and attracting huge sums of money, or are they being dismissed with appropriate skepticism? Is credit easily available on loose terms, or is it tight and expensive, maybe impossible to obtain for riskier borrowers? Are yield spreads, that extra return investors demand for taking on more risk compared to safer assets, tight, meaning little fear, or wide and generous, meaning lots of fear. All of these qualitative factors, he says, are important clues. And crucially, none of them entail forecasting the future direction of the economy or the market. You are simply observing and interpreting the present conditions.
Okay. So the core strategy that emerges from this deep understanding of cycles and our current positioning is essentially contrarianism, right? Acting opposite to the prevailing sentiment and behavior.
Absolutely. This is the cornerstone of Mark's practical investment philosophy. He states it very clearly. When others are recklessly confident and buying aggressively, we should be highly cautious. When others are frightened into inaction or panic selling, we should become aggressive. The reasoning is straightforward. Investor behavior ultimately determines asset prices and the relationship to intrinsic value, at least in the shorter term. The very aggressiveness and optimism of others makes the market a risky place for you as an individual investor because it pushes asset prices above their underlying worth. Conversely, their fear makes it safer and potentially more profitable for you.
So when everyone else is feeling invincible and buying hand over fist, that's precisely when you need to be most cautious, maybe even selling or holding cash. And when everyone else is paralyzed by fear and selling indiscriminately, that's your moment to act, even if it feels deeply uncomfortable.
Exactly, and it's not just theory. Marx and his firm, Oaktree Capital, famously put this into practice during the harrowing 2007-08 global financial crisis. Despite the widespread panic and market collapse, they invested a lot, particularly in the distressed debt markets we discussed earlier. They focused on the senior, supposedly safer debt of high-quality companies whose prices had nonetheless plummeted due to the crisis. They observed the extreme risk aversion, they saw the absurdly cheap asset prices caused by that fear, and they acted decisively. They were, as he puts it with characteristic understatement, amply rewarded for their contrarian behavior when markets eventually recovered.
And for Marx, there's also a cardinal sin in investing, something to absolutely avoid if you want to succeed long-term through these cycles.
Yes, he is unequivocal on this point, and it's a critical lesson, he says. Exiting the market after a decline, and thus failing to participate in a cyclical rebound, is truly the cardinal sin in investing. Converting a mark-to-market loss, meaning a temporary paper loss on your holdings that fluctuates with market prices, into a permanent realized loss by selling out at or near the bottom is really terrible. It means you experience all the pain of the downturn, but none of the eventual recovery. This mistake locks in losses permanently and removes any chance of recouping them when the cycle inevitably turns up again.
So understanding cycles isn't just about spotting opportunities. It's also about having the emotional fortitude, the discipline, and maybe the financial wherewithal not being forced to sell, to simply live through the downturns without panicking. That sounds like an essential ingredient in long-term investment success.
Absolutely. It's about resilience and discipline, staying power, not just intellectual understanding of graphs and numbers or trying to time the market perfectly. The enduring nature of cycles and the illusion of this time is different.
So we've seen how these cycles work and how to potentially navigate them. But why do they persist despite all the painful lessons from history? And why do we, as collective human beings, keep falling for that incredibly dangerous illusion that this time is different?
It's a great question, and Marx argues that the basic reason for the cyclicality in our world is the involvement of humans. Unlike purely mechanical or physical processes, which might proceed in a more linear, predictable fashion, processes in fields like history and economics fundamentally involve people. And people, as we know all too well, are emotional beings. Their collective greed, fear, optimism, pessimism, envy, ego, all these things lead to inherent variability, overshooting, and cyclicality in the systems they influence. The physicist Richard Feynman once quipped something like, "Imagine how much harder physics would be if electrons had feelings." Well, investors do have feelings, and that introduces an element of inherent unpredictability and cyclical behavior into markets.
And it seems we compound that problem because we have a remarkably short financial memory. We just forget the last crash.
That's a huge perpetuating factor. Marx observes quite pointedly that there can be few fields of human endeavor in which history counts for so little as in the world of finance. New generations of investors and professionals enter the market, often supremely self-confident and utterly convinced they've made a brilliantly innovative discovery that renders past rules obsolete. They often dismiss past experience, the lessons learned by those who lived through previous cycles, as simply the primitive refuge of those who do not have the insight to appreciate the incredible wonders of the present. It's kind of generational arrogance, maybe.
Can you give us some specific examples of this time is different, illusion playing out, even with supposedly highly intelligent people falling for it?
Certainly. Marx provides several. For instance, back in 1996, despite what had already been a pretty long economic expansion in the U.S., prominent figures, including top economists and CEOs from major Fortune 500 companies like Sears, Amoco, and Sara Lee, confidently declared in the press that the big bad business cycle has been tamed. And even that, there is no natural law that says we have to have a recession. They thought they'd conquered it. Yet, sure enough, a modest recession followed just a few years later in 2001, and then, of course, the devastating Great Recession of 2008-09 arrived, powerfully underscoring the fallacy of that belief. The business cycle was very much alive.
And incredibly, even after the trauma of the global financial crisis, that illusion somehow managed to return, didn't it?
Yes, it's quite amazing how quickly it reappears. In the years following the GFC, there was much serious discussion, even among policymakers and economists, about a potential great moderation, a supposed quasi-permanent era of resilience in the economy, perhaps due to financial innovations, ironically, and better central bank policy. The recurring belief was, once again, that maybe risk was gone, or significantly diminished a dangerous illusion that Marx consistently points out reappears almost every time things feel good and stable for a while.
This reminds me of the silver bullet phenomenon he talks about, that related deceptive idea that you can find an investment or strategy offering high returns without taking significant risk, the free lunch.
That's a crucial danger sign he warns about. Many bubbles and periods of extreme speculation are underpinned by the seductive belief in a silver bullet, an investment strategy, a new technology, a particular asset class that somehow promises high return without risk. Marx challenges this notion with two simple, piercing questions that you should always ask yourself when presented with such a proposition. First, why would the purveyor offer it to you rather than keeping it all for himself and getting rich? And second, if it really were a sure thing, wouldn't everyone else pile into it, driving up its price to the point where it's no longer a sure thing, where the high return is competed away?
Right. Basic logic. If it sounds too good to be true, it almost certainly is, because markets are generally efficient at pricing obvious opportunities.
Exactly. His practical application here is invaluable. The fact that investors are willing to swallow a promise of return without risk is an infallible indicator that skepticism is in short supply, psychology is overheated, and the subject asset is overestimated and thus probably overpriced. He advises you to watch out for these promises, recognize them as a sign of market froth, and resist them. Though he wryly notes that few people do resist when a real bubble is truly forming and the hype is deafening.
So ultimately, learning from cycles isn't really about predicting the future with certainty, is it? It sounds more like preparing for a range of possible futures with greater wisdom and resilience.
Exactly. That's the core message. Marx highlights that the key elements contributing to past market extremes, things like overwhelmingly good economic news, favorable articles everywhere, carefree, risk-oblivious behavior, unusually strong recent returns, fueling extrapolation, extremely high valuations, unquestioning belief in narratives, all these things were generally clear to see at the time for those who were observant and skeptical. He stresses that drawing the essential inferences and thus taking the appropriate actions, like becoming more cautious when signs point to overheating, didn't require any forecasting at all. It just required paying attention to the present and understanding historical patterns.
So you don't need a crystal ball. You just need open eyes, a clear, analytical mind grounded in history, and the discipline to act against the prevailing mood of the crowd when necessary.
Precisely. And he's humble about it, too. He candidly admits he didn't fully appreciate the power and nuances of the credit cycle early in his own career. He says it's something you've lived through to truly grasp its impact. But his firm's considerable long-term success comes, in large part, he says, from having used the cycle to our advantage over many decades. The key takeaway is that it's not about knowing where we're definitively going next month or next year. It's about recognizing where we stand right now in the cycle. Are things heated or depressed? Are valuations high or low? Is risk appetite rampant or absent? And then adjusting your portfolio attributes accordingly. That means adjusting your level of risk consciousness, conservatism, discipline, selectivity, and patience based on that assessment of the current environment.
That's a powerful and actionable message. It puts the control back in the investor's hands, focusing on what you can assess, which is the present, rather than relying on uncertain, unprovable predictions about the future.
It empowers you to act rationally based on observation, not just hope or fear.
Yeah.
Outro.
So we've taken a deep dive into Howard Marks's Mastering the Market Cycle, and what a journey of insight it's been. We've learned that cycles, especially in these complex human-influenced systems like financial markets, are absolutely inevitable. You can't wish them away.
That's right. And they're driven by those powerful oscillating forces of human psychology, that constant pendulum swinging between greed and fear, euphoria and depression, skepticism and credulousness. It's built into us.
And crucially, we've understood that the key isn't to predict exactly where the market or the economy is going next, because that's probably impossible to do consistently. Instead, the goal is to accurately assess where we stand in the current cycle. Is the pendulum near an extreme?
Exactly. That knowledge of the present, combined with the discipline to be a thoughtful contrarian, to lean against the prevailing wind, allows you to manage risk more effectively and seize opportunities when others are either recklessly confident or paralyzed by fear. It's fundamentally about avoiding that fool-in-the-end mentality that we saw even Sir Isaac Newton, surprisingly, fall victim to during the South Sea Bubble.
So here's a final provocative thought for you, our listeners, to chew on as we wrap up. If cycles are truly inherent in human behavior and the systems we create, and if history consistently rhymes but never exactly repeats, what does that imply for other areas of your life beyond just investing? Think about your career path, perhaps, the dynamics of your personal relationships, even broader social trends, or the progress of technology. If success itself truly carries the seeds of failure, and failure can plant the seeds for future success, how can you apply this cyclical understanding to anticipate potential challenges and opportunities in your own endeavors? Recognizing that, as Marx implies, being too far ahead of your time is indistinguishable from being wrong, yet acting early before the crowd is often rewarded. It's a fascinating tension, isn't it? It's really about being prepared for the ebb and flow, rather than trying to predict the exact timing of the tides.
A fascinating challenge indeed. It suggests a certain humility, but also encourages proactive awareness in all sorts of domains. What stands out most to you from today's deep dive into Marx thinking?
Lots to think about there. Until next time on The Deep Dive, keep digging deeper.